A UK fintech is managing $90 billion in assets. Its founder has a government advisory pass, a private jet, and the backing of SoftBank. 11 days after a single insurance contract lapses, the entire thing is gone. Here is what actually happened. Supply chain finance is not a glamorous concept. A supplier delivers goods to a large corporation. The corporation agrees to pay in 90 days. The supplier needs cash now. A finance company steps in, pays the supplier early, and collects the full amount from the corporation later, keeping a small fee. That is supply chain finance. It is old, it is unglamorous, and it works. Lex Greensill grew up on a sugarcane farm in Bundaberg, Queensland. He watched his parents struggle to get paid on time by the companies that bought their crop. That experience, he would later say, was the origin of his entire business philosophy. He studied law in Australia, then moved to the UK, worked at Morgan Stanley, then Citigroup. He learned the mechanics of trade finance from the inside. In 2011, he founded Greensill Capital in London. The pitch was simple: make supply chain finance faster, cheaper, and available to companies of all sizes. Instead of banks, Greensill would package the receivables, the money owed by corporations, into investment notes. Those notes would be sold to investors through Credit Suisse funds. The investors got a yield. The suppliers got cash. Greensill collected fees at every step. On paper, it was elegant. By 2018, Greensill had processed more than $60 billion in transactions. Its client list included Vodafone, Airbus, Ford, and the UK's National Health Service. SoftBank's Vision Fund invested $1.5 billion in 2019. That single injection valued Greensill at $7 billion. Lex Greensill was now a billionaire, at least on paper. He had acquired a Gulfstream G650, one of the most expensive private jets available. He had offices in London, New York, Frankfurt, Chicago, and Sydney, and he had something no fintech founder typically gets: direct access to the British government. In 2012, Greensill had been appointed as an unpaid advisor to the Cabinet Office under David Cameron. He helped design a supply chain finance scheme for NHS suppliers, a scheme that, coincidentally, his own company could service. David Cameron, after leaving office, joined Greensill as a senior advisor in 2018. His compensation included share options that, at the company's peak valuation, were worth tens of millions of pounds. Cameron used his contacts to lobby the Treasury and the Bank of England on Greensill's behalf. He sent text messages directly to Chancellor Rishi Sunak. He pushed for Greensill to be included in the UK's COVID-19 emergency lending schemes. The lobbying was later described by a parliamentary inquiry as a case study in the risks of revolving door politics. But the political connections were a symptom, not the disease. The disease was Sanjeev Gupta. Gupta ran GFG Alliance, a sprawling empire of steel mills, aluminum smelters, and energy assets across the UK, Australia, France, and India. By 2020, GFG employed roughly 35,000 people worldwide. GFG was also almost entirely financed by Greensill. Greensill had extended roughly $5 billion in financing to GFG entities. That was more than half of Greensill's entire loan book. Concentration risk of this magnitude would have failed any standard banking stress test, but Greensill was not a bank. It operated through a small German bank it had acquired, Greensill Bank AG in Bremen, and through Credit Suisse's asset management division. Credit Suisse ran 4 supply chain finance funds on Greensill's behalf. Those funds held $10 billion in assets at their peak. The investors included pension funds, insurance companies, and sovereign wealth funds. They believed they were buying short-term, low-risk trade receivables. What they were actually buying was far more complicated. Greensill had begun financing receivables that did not yet exist. These were called prospective receivables, invoices for transactions that might happen in the future. In practice, it meant Greensill was lending money against revenues that GFG Alliance had not yet earned and might never earn. The Credit Suisse funds were, in effect, funding GFG's operations, not its invoices. This violated the basic premise of supply chain finance. It also violated the prospectuses of the Credit Suisse funds. Credit Suisse's own due diligence teams had raised concerns as early as 2019. Those concerns were overridden. The funds were generating fee income for Credit Suisse and strong yields for investors. Nobody wanted to ask too many questions. The entire structure was held together by one thing: insurance. Greensill had arranged trade credit insurance policies to cover potential defaults on its receivables. The insurers, primarily Tokyo Marine and the Bond and Credit Co., were covering billions of dollars in exposure. In late 2020, the insurers began to understand what they had actually underwritten. In July 2020, the Bond and Credit Co. refused to renew its policies. Greensill appealed. It lost. Without insurance, the Credit Suisse funds could not continue to operate under their stated risk parameters. On March 1, 2021, Credit Suisse suspended the 4 supply chain finance funds. $10 billion in assets was frozen. Investors could not withdraw their money. Greensill's business model required a constant flow of new investor capital to repay maturing notes. With the funds suspended, that flow stopped. Greensill scrambled for alternatives. Apollo Global Management held talks about acquiring the business. Apollo walked away. On March 8, 2021, 8 days after the fund suspension, Greensill Capital filed for administration in the UK. Grant Thornton was appointed administrator. The company that had processed $150 billion in transactions over its lifetime had, in 11 days, ceased to exist. The consequences spread immediately. Greensill Bank AG in Bremen was seized by German financial regulator BaFin. BaFin found that the bank had loaded its balance sheet with bonds issued by GFG Alliance, a severe conflict of interest. German municipalities had deposited over $500 million in the bank. Those deposits were now at risk. GFG Alliance, deprived of its primary funding source overnight, teetered on the edge of collapse. Its steel plants in the UK, in Rotherham, Stocksbridge, and Hartlepool, faced immediate uncertainty. Thousands of steel workers faced an uncertain future. The UK government quietly provided emergency support to keep the plants running. Credit Suisse faced a different reckoning. The $10 billion in frozen funds had to be wound down. Recoveries were partial. Investors in the funds ultimately recovered roughly 90 cents on the dollar, but the process took years. Credit Suisse's asset management head resigned. The bank paid $495 million in settlements to fund investors. It was one of a cascade of scandals, Archegos, Greensill, the Mozambique tuna bonds, that would ultimately destroy Credit Suisse as an independent institution. In March 2023, UBS acquired Credit Suisse in an emergency rescue brokered by the Swiss government. 167 years of Swiss banking history ended in a weekend. David Cameron's role was examined by a parliamentary inquiry in 2021. The inquiry found that his lobbying had been not unlawful but inappropriate. His share options expired worthless. He faced no criminal charges. Lex Greensill returned to Australia. He gave evidence to the UK parliamentary inquiry via video link. He denied wrongdoing. He has not been charged with any criminal offence in the UK. The Serious Fraud Office opened an investigation in 2021. As of 2024, that investigation remains ongoing. Sanjeev Gupta faces separate fraud investigations in the UK, France, and Australia. GFG Alliance continues to operate, restructured, and diminished. What the Greensill collapse revealed was not a single rogue actor. It revealed a system in which every participant had an incentive to keep the machine running, and no single participant had an incentive to look inside it. Credit Suisse collected fees. SoftBank protected its valuation. Cameron protected his options. Gupta protected his access to capital. And Greensill protected his image as the farm boy who had reinvented global finance. The machine ran until the insurance ran out. Then it stopped, and everything it had been holding up came down with it. The final number is not $7 billion, the peak valuation. It is not even $10 billion, the frozen Credit Suisse funds. The final number is $5 billion, the amount owed by GFG Alliance, most of which was never recovered. That money did not disappear into abstraction. It came from pension funds, insurance companies, and public institutions that trusted a piece of paper Greensill had written about invoices that never existed. In the end, the most expensive thing Greensill Capital ever produced was the invoice.